Okay, so let's talk about some of the traits of partnerships, and let's start with taxation. All right, so the partnerships are for profit entities. They're formed to generate profit, income, but they do incur no tax liability. What? How so? All right, you know. Well, they file an informational return that shows um, how much income or profit the corporation, the partnership, earned, but um, that's just for information, right? So the partners themselves are taxed on the income of the partnership. So if partner A and partner B uh, um, operate a partnership that generates $10,000 during the year, if they're equal partners, partner A is going to be taxed on $5,000 of partnership income. Partner B is going to be taxed on $5,000 of partnership income as well. But the partnership itself has no tax liability. So that's called pass-through taxation. And that's how partnerships are generally taxed. They file a return that tells the IRS this is how much we made, and this is each partner's share. And they also have to issue a Schedule K-1 to each partner, and that partner then reports it on their own personal taxes and obviously pays the tax there. Okay, let's talk about the law applicable. All right, so there's a lot of partnership law in this chapter, but keep in mind, partners are in charge of their partnership agreement and have the ability to agree to things that contradict either the common law or the Uniform Partnership Act. All right. So if you don't like a default rule, because that's what the common law and the Uniform Partnership gives you, is if you don't like a default rule, contract around it, agree to something else. All right, and we'll talk about several of these examples in the next slide or two. Before we do so, let's talk about partnership by estoppel. All right. Partnership by estoppel is an equitable remedy, which means a legal fiction created in court or by a judge to prevent unjust enrichment or unfair, inequitable treatment of one party that benefits another. All right. And so what partnership by estoppel does is it allows for people who are not partners but may have held themselves out as partners to be treated as partners in litigation, because failure to do so allows one party to be unjustly enriched, i.e. to make some money at the expense of another. All right. So that's what partnership by estoppel is. That was a mouthful. Let's run through an example. So I am operating my business as a sole proprietor. All right. But I know that sole proprietors have difficulty raising capital. So I simply walk into the bank with my father standing next to me and say, this is my business partner, and let's say my father is well known in the community and respected, and his presence and also agreeing or stating that he's my partner allows me access to a loan. All right. The loan is made and I later default on that loan. Well, I am going to be sued for non-payment, But my father, who said he was business partner, would also be sued. And so when he raises the defense that, yeah, I'm not actually his business partner, I just said that, seemed like the thing to do at the time, right? Well, the court is going to hold my father liable as a partner by estoppel because he allowed for the image or represented himself as partner. So he would be treated as one legally, which means he would be liable for the payment of the loan that I've defaulted on jointly and severally. All right. So partners have rights and duties. The rights, and there are more than these, but we'll start with these. Management. So partners have equal vote, irrespective of their investment in the firm. So if partner A and partner B form a partnership, and partner A contributes $100,000, partner B contributes $10,000. Well, when they have their first partner vote, partner A has the exact same vote as partner B. He or she doesn't have any more clout or decision-making power than the other. Again, the default rule, you can agree to something else in the partnership agreement, but that's the default rule. Everybody has the exact same vote. So a 1% partner can prevent, or I can say can be just as influential as a 99% partner unless they've agreed to something else. All right, profits. So the default rule is profits are shared equally, irregardless or irrespective of investment in the firm. So the same example, partner A contributes $100,000, partner B contributes $10,000. Well, at the end of the year, the partnership has made $500,000. Well, partner A's share of income is $250,000. Partner B's share of income is $250,000. Again, default rule, you can always agree to something else. All right. Adding on to this, however, is that losses are distributed in the same manner that profits are. So if profits are distributed equally, then losses would be as well. If profits are not distributed equally, then losses would not be either. Right. If I take 80% of the profit, then that means I'm going to take 80% of the loss if the partnership is not profitable. All right. Compensation. Partners do not have a right to compensation. The partnership can agree to pay compensation to a partner, but no obligation to do so. And partners do have the right to access the accounting records as well. All right. So those are your basic rights of the partners. Fiduciary duties. We covered these in the agency chapter. They're still the same. So I'll make it real quick. I know the agency, I think it was the first chapter we covered. So duty of care. That just means partners must use the same level of care they'd use in their own financial affairs. They need to use that level of care in partnership affairs and business. All right. And the duty of loyalty is the spotlight case in the book is Minor versus Salmon, which does a good job of illustrating a breach of the duty of loyalty. All the duty of loyalty says is that partners have to disclose business that can affect the partnership business, and can't take prospective business for personal gain if it relates to the business of the partnership. Right. So Minor versus Salmon in the case is where there were two partners that had renovated a building and were operating a hotel, and one of the partners received an offer to raise the building and manufacture another type of business on that land, kind of a highest and best use thing. And he didn't share that information with his then partner while the partnership was active, and that was found to be a breach of the duty of loyalty. Okay. Liability. We'll talk a bit about liability when we talk about the types of partners. But let's talk about types of liability, and we'll match these to the types of partnerships momentarily. So joint and several liability is very similar to that of it's very similar to what you'll have in a sole proprietorship, only it's spread across multiple partners. This means that any partner can be held liable for the totality of any partner liability. When the partnership is sued, the injured party, the plaintiff, has the ability to sue the partnership, any individual partner, even if the partner being sued is not at fault, or all of the above. So you can sue all of the partners and the partnership itself, and any of those entities can be held fully liable. That's joint and several liability. Joint liability is similar. All joint liability is that when a partnership is sued, all partners have to be party to the lawsuit. So you have to name every single partner. All right. Disassociation is the term for when a partner leaves the partnership. All right, they are said to have dissociated from the partnership. All right. And partners always have the ability to leave the partnership, but they may not have the right to do so. All right, so dissociation can be wrongful if the partner didn't have the right under the partnership agreement or the contract to leave the partnership. All right. Termination. So dissociation is when a partnership leaves the partner. Termination is when the partnership says, okay, we had about enough, we're going out of business, we're going to stop operations. Right, and that's the process by which business is wound down, so no new contracts. The business can complete existing contracts with its customers and pay all creditors, any amounts owed, liquidate remaining assets, and then once all creditors are paid, partners get their share of the kind of a liquidating partner liquidating partnership draw. All right, so that's how a partnership is terminated.